All right, class, welcome back. Here we pick up where we left off in talking about capital assets and capital gains and losses. So we're returning to the idea of section 1231, business assets. Remember I said that there might be situations where you could have the best of both worlds. Short-term sales are the worst of both worlds, meaning like we talked about, they have ordinary income and limited capital gains. So it's section 1231 are specifically those that are used in a trade or business held for one year, okay? Most of the time they're going to be depreciated. So we first of all apply the netting to all section 1231 assets before we look at any other assets. So everything goes into this bucket first, okay? And if you have more gains than losses, then your net section 1231 is a long-term capital gain. Remember, that's the lower tax rates. All right? If there is a loss, okay, it is an ordinary loss. All right, so that's the best of both worlds. So you get the ordinary loss, which means you can offset it against ordinary income, and you don't have to worry about the $3,000 limit. But on the gain side, you can have a capital gain and so forth. So there's got to be a catch, right? And the catch is right here in these recapture provisions, because most of the time the section 1231 assets are depreciable. That means that they've been depreciation deducted from that accumulated depreciation over the years that you've held the asset. When you calculate your gain, your section 1231 gain, you have to look at how much depreciation has been recorded on that asset. So remember, depreciation was subtracted out to get the adjusted basis. You go back and you look at, okay, so I have a gain. I look at how much depreciation I recorded. If my gain is less than my depreciation, then the amount of the depreciation, okay, the amount of the gain is an ordinary income. It's not a capital gain. It's ordinary income. All right? So that transforms most 1231 gains into ordinary gains, like it says there on the slide. So an example, I bought an asset for $10. I depreciate it for $5. So my net, or my adjusted basis is now $5, the remaining $5. I sell it, okay, for $7. So my gain, my section 1231 gain is $2, right? I sold it for $7. My adjusted basis is $5. However, my depreciation recapture says, all right, up to $5 of that gain has to be ordinary income. So when I sell it for $7, my $2 gain is ordinary income, not capital gain. The only way that I would have capital gain is if I sold it for more than I originally paid for it. So I had sold it for $11, I would have $5 of ordinary income to recapture the depreciation, repay me, if you will, for the depreciation I deducted in past years, and then $1 of capital gain for the amount over the original cost. Okay? So if you have losses, you don't have to worry about $3,000 we mentioned. The section 1245 is where the recapture provisions are in the code, okay? And it applies to those that are depreciable personal property, not real estate, not personal use property, but things used in the business that are not real estate. Section 1250 is buildings and real estate, okay? Now, it has a similar situation in that you have, when you calculate the gain, you have to look back at the accumulated depreciation. Okay, and this is where this relates back to chapter 6. The depreciation's deducted, and the amount of the gain up to the depreciation is section 1250 gain, and has a 25% rate. Okay, although it can never be more than your ordinary income, so it's the maximum is 25%. All right, but it's going to be your regular ordinary income up to that. And then you get, so again, here's a building, you bought it for 10, depreciated it for 2, so its adjusted basis is 8. You sell it for 12, $2 of that is recapture depreciation tax at 25% rate. The other $2 is ordinary income, capital gain, because that's over the amount you originally paid for it, and that gets the special rates based on your tax bracket we talked about earlier. Okay, so some special types of sales. All right, let's say you bought stock in a company on multiple dates. All right, so you bought stock in January and then again in April because you were accumulating this investment. You kept thinking this is a great deal. When you go to sell it, how do you know what your basis is? Let's say you paid $10 a share in January and $12 a share in April. What do you use when you calculate your gain or loss? Well, you got two choices. You can tell your broker that you want to sell the ones in January or the ones in April. You can specifically identify which ones they are. Or if you don't do that, it's called, you use FIFO. You remember that from Accounting 101, first in, first out. So if you bought it in January, April, and say August, when you sell it, you're automatically going to, unless you designate otherwise, you're going to assume what you're selling first, the January, then the April, then the August. Okay, mutual funds works a little differently, and you can use the weighted average instead of FIFO. You typically get a 1099 DIV, and that shows you the dividends, capital gains, distributions. You can get all of those from a mutual fund. Okay, we've talked about dividends in an earlier chapter. You could have capital gains, all that. All of that goes on the Schedule D. Okay, if you don't have much, you can put it directly on 1040, but I've always put it on Schedule D, and then flow it to the 1040. All right, we talked about the different ways that they can do it. You can use the average basis for mutual fund shares, where you can't for anything else. All right, but this is used an awful lot more under the mutual fund. That's typical as the average. All right, what about something that the company just goes bankrupt? All right, so they are treated as losses of a capital asset on the last day of the year. So what it says here is declaration of bankruptcy is not sufficient because some companies come back. So it depends on the type of bankruptcy, and they have to literally become defunct. The thing that happens, if you bought stock in a company that becomes defunct, you're not going to be able to sell it. So there has to be some provision that you can have a loss on that even though you can sell it. Because typically you're going to, say you bought it for $10 and you sold it for 50 cents. That's easy to calculate your loss on, okay? Just like you would if you bought it for 10 and sold it for 7, okay? But if it's worthless and you can't sell it because there is nobody to buy it, then you have to be able to show that it's worthless, and then you don't have necessarily a specific date. It's going to be dealt with at the end of the year. I would definitely think that this should be long term. I'd hate to think a company could go this belly up, this fast in less than a year, but it should be a long-term situation based on the last day of the year that it was determined to be worthless. And then your loss would be the amount you paid for it down to zero, right? So, fair market value and adjusted basis at time of gift. Remember, we talked about donor's adjusted basis for a gain, fair market value for a loss. Okay, so this is stuff that's given, you're given as a gift to someone else, and now they're selling it. All right, so I gave it to them, they're going to sell it. You use the donor's adjusted basis, and the fair market value is less than the adjusted basis. Remember that kind of special situation. All right. If it's more, then it's easy. That's the part of the bottom. The difficult part is if the fair market value at the time of gift is less than what the giver paid for this stock, let's say. All right. So if it's less than, then I have two bases. I have a gain basis and a loss basis. I use the donor's adjusted basis, the higher amount, okay, for gain. And I use the fair market value for a loss. That means that I'm going to have a lower loss and a lower gain, both, okay? So if I sell it for above the donor's adjusted basis, then I use the donor's adjusted basis to calculate the gain. If I sell it for below for fair market value for a loss, then I use that fair market value for a loss. If I sell it anywhere in between the fair market value or the adjusted basis, then it is no gain or loss on the sale. Okay, so let's say that I receives stock, donor's basis is $8, fair market value is $6. All right, if I sell it for less than 6, I use the 6 to calculate the loss. If I sell it for more than 8, I use 8 to calculate the gain. If I sell it for 7, in between, no gain or loss. Okay. And then this is how it would work if you went forward to sell the property, okay, that you received as an inheritance. Always long term, okay, and then it would be a capital gain or loss. And qualify for the preferential tax treatment. And that is our conclusion on tax, our capital gains, and the taxability of those sales.